In today's stock analysis, we are going to examine the key pillars, look at past results, see what the analyst's predictions are, create a valuation, and find out what our potential return will be, and review then rate the company. Today we are going to look at PayPal. Let's dive into the process I follow when reviewing whether or not to invest in a company. After I've collected all the financial information, I then analyze what I consider to be the 12 key pillars. These pillars are based on the insights and teachings of the best super investors, and what I consider to be the key metrics when evaluating a company. Ideally, we would like to see each of these metrics be at least 10%. The first pillar is earnings per share. This is where we take the net income and divide it by the shares outstanding. For PayPal, this is looking great for the trailing 12 months, as the earnings per share has increased by 10%. Now, let's look at the free cash flow, which is the money a business can generate from its operations. Warren Buffett emphasizes the importance of strong financial health and prefers companies that can generate substantial free cash flow. And here we can see, PayPal improved their free cash flow by an excellent 97%. Then we come to the next pillar, which is revenue, and this tells us how good the company is at generating income before deducting expenses. PayPal's revenue has increased by 10%. Then we come to book value, which is calculated by subtracting the total liabilities from the total assets, and this indicates equity growth for the company. Phil Town believes book value growth is the most important metric, as it has the interest of the shareholders at heart. For the last 12 months, their book value has improved by 4%. Now let's turn our attention to the management of the business by looking at the return on invested capital and return on equity. These two measures allow us to assess a company's efficiency at allocating the capital under its control. Return on invested capital and return on equity are excellent at 15% and 22%. Now we move on to debt. And Joel Greenblatt prefers companies that are able to pay off debt with their free cash flow, ideally within 3 years. And it would take them under 1.5 years to pay off the debt. At present, with the information we have gathered, it tells us that PayPal's key pillars look good so far, so let's find out more. Tap the like icon if you have found the information helpful, and click on the notification bell to get alerts about my next videos. In this next section, we now focus on other key pillars which help define an excellent business. Now let's look at the gross margin, which is the amount of money a company retains after incurring the direct costs associated with producing the goods it sells and the services it provides. This is currently at 40%, which is good, as we would like to see the gross margin at or over 40%. Next, we come to the operating profit margin. This tells us how much profit a company makes on a dollar of sales after paying for costs of production, such as wages and raw materials, but before paying interest or tax. Peter Lynch prefers companies with strong operating margins when assessing its financial health and competitive advantage. Their operating profit margin is a superb 17% and is above our target of 14%. For Terry Smith, free cash flow yield provides a more realistic view of a business's financial health and profitability. He typically looks for companies which have a free cash flow yield of 5% or higher. So, at 10% this looks excellent. As we are potential shareholders, we will now want to look at the average book value growth for the last 10 years. This is just 6%, with the lowest point being last year at 2%. And lastly, Bill Miller believes earnings growth is the biggest indicator to a company's stock price. The average growth for the last 5 years is 22%. In the comments section, I've included a link to the investors page in the annual report, if you want to check it out for yourself. This is Bitesize Investments, giving you a step-by-step approach on your investment journey. Now let's look at past historical performance, to give us a better understanding of the company's successes and failures the business has been through. Looking at the chart, we can see that in 2020, when the market dipped, their share price went as low as $87, but rocketed to a peak of about $309. But crashed heavily during the market dip of 2022, and has struggled to regain their lofty share price. We can see their current market cap is $74.05 billion. They are currently generating $31.03 billion in revenue. Their net income is $4.44 billion, and they have been buying back shares, and have reduced their outstanding shares to $1.02 billion. At present, their earnings per share tells us that for each share of stock, the company earned $4.13 of profit. And finally, the current P ratio is 17.52, which suggests the company is cheaper than the S&P 500, which has a PE of about 27. On average, the analysts believe that the price target should be about $75.88. With the overall consensus being a buy, it is also predicted they will grow between 9 and 27% over the next few years. Now I am going to show you how to create a valuation. I will use the current earnings per share of 4.24. Now I use a combination of the past growth and future analyst predictions to create the estimated earnings per share growth. To create a valuation, I'm going to give PayPal a 10% growth rate. Then, I am going to give them an estimated PE ratio of 27. After that, I will project these numbers forward by 10 years. We then need to include a 15% return from our investment. This then gives me an estimated future stock price of about $297 per share for its future share price. And then we work out the current value, that Phil Town calls the sticker price, which is about $73. Then we apply a margin of safety. At 25% it gives me a buy price of about $55. Please consider sharing this video with someone you think they will find it helpful, and click on the link above to check out my last stock analysis. The return we would receive if we bought at our 25% margin of safety price of $55 and sold in 10 years' time at our estimated future stock price of $297 would be 440%. But this is dependent on our assumptions for the company being correct. In addition, PayPal don't currently offer a dividend. If you have enjoyed this video, let me know in the comments section. And finally now, we'll summarize what we have found out about the company. When reviewing the key pillars, PayPal scored 10.5 out of 12. For this, I will give them a check. As for the past results, their average share price has been going sideways since the market dip of 2022. Therefore, I will give them a cross. Analysts are signaling PayPal as a buy, and predict they will grow between 9 and 27% over the next few years. Here they gain another check. Using the EPS growth model I used earlier on, we created a buy price of about $89. Therefore, I will give the valuation a check, as the current share price is below this. According to Morningstar, PayPal have a narrow economic moat, and are viewed as a turnaround stock, with the aim of returning back to being a growth company, so I will give them a cautious check. As you have to believe they are capable of achieving this target. My final overall rating is 4 out of 5 stars. The 12 key pillars are the essential part of my process, and a company must score over at least 7 of them for me to seriously consider the stock. Therefore, I have given this a category A rating within my own stock watch list. Thank you for joining me during this stock analysis video, and I hope to see you in the next one.